Thanks everybody for coming to the second of our STEAM COP26 lead-up seminars, and I'd like to hand over to Professor Susan Hart, who's the Dean of Durham Business School, and will provide us with the background and context of the series. And thank you very much for agreeing to come today and to provide that information around it and all of the information that Durham is doing for the COP26.
Thank you, Julian. It's a great pleasure and an honour to be asked. I'm just so aware that across Durham University and indeed in the Business School, there is so much really interesting and engaging research going on, very vital research going on in all aspects, many aspects, perhaps not all, but many aspects of the great challenges of sustainability. And as a business school, we are also focused on that. So I would like to welcome everyone to this second seminar in the series on Durham University's thought leadership in advance of and leading up to COP26, which is in my hometown in Glasgow. At the Business School, we have a very clear statement of our purpose, which I believe, and I hope my colleagues believe, is lived in the kind of research and educational activities and indeed the external engagement that we are involved with at the school. And that is to develop and enthuse leaders and entrepreneurs, because we think that leadership is in many different contexts, who will create, share and use knowledge to deliver, and this is important, equitable and sustainable futures around the world. So right at the heart of our stated purpose is this idea that we are a business school, so we exist to inform and to learn from business, industry, trade, policymakers, all about the wealth creation that's required, but also that wealth creation process will have some unintended consequences, as we have seen, many unintended consequences, as we have seen, and that also the creation of wealth is then not equitably distributed around the world, a bit like the COVID-19 vaccines are not equitably distributed around the world as yet. So it's important for us that we are engaged in conversations and narratives and research and education that is dealing with not only wealth creation, but some of the more negative effects and how they can be mitigated, and also how we can spread and encourage the spread of that wealth for the benefit of all humanity and indeed taking care of the planet. So the way in which we conceptualize this is clearly we are part of a university, a prestigious university. We are integral to that and very proud of that, through our research, our education, and the experiential opportunity that we wish to offer both our faculty colleagues and also students of being involved and engaged with worlds of practice, not just commerce and industry, but obviously that features very largely, as you would expect, in a business school. But threaded through those three areas of focus, research, education, and experiential opportunity, is a very strong theme, which we call one of our transversal themes, because they thread through horizontally, if you like. And that theme is about ethics, responsibility, and sustainability. We are signatories and actively pursue objectives through something called the Principles of Responsible Management Education. And even pre-COVID, because it has become a little easier, ironically, because of COVID, we have goals of partnership with industry and policy bodies, and very high amongst our commitment is our goal to achieve 45% absolute reduction in carbon across all of our activities by 2030, and to achieve net zero emissions by 2040. And we have done this and are doing this actively through a very clear carbon management plan, which we follow as a school and which we are also aligned to the university's plans. We also have a number of examples right across the school of research which is focused in areas to do with sustainability, and climate change is implicated in that. So for example, one of my colleagues, and we'll hear from Laura and Thomas later very, very soon, and I'm really looking forward to hearing what they have to say. But another example of that would be Professor Omnaya Abdul Salam, who's working with Start Microfinance, helping the organizations to implement UN Sustainable Development Goals, the SDGs, all around microfinance in developing countries, for example. So it has a reach there. And indeed, we have a number of researchers who are very focused on elements of digitalization, innovation, entrepreneurship, and creativity. So recent examples of research in those fields which impact on climate is the work of Professor Kostas Nikopoulos. He's part of a European Ramones project, wonderful name for that, which examines natural and artificial radioactivity in oceans. Now, this is funded by Horizons Europe, and Kostas' work is focusing on decision-making processes and model theories as they model this artificial radioactivity in models. So there we have somebody from the business school looking at business processes, decision-making, and how that affects this phenomenon in our oceans. Similarly, or in contrast rather, Professor Kieran Fernandez is working with the Centre of Process Innovation and the CBI partnership with the Federation of Small Business and Materials Processing Institute to provide support for resilience strategies in face of the pandemic. And only a few weeks ago launched a summit and a white paper on a smarter society, smarter business and smarter cities. And although digitalization and the pursuit of knowledge clearly and the capture of knowledge and information is central to that, also central to smart cities are cities which are less destructive, shall we say, to the environment. And that is a big part of the work that goes on there as well. Another of my colleagues, Professor Nick Ellis, is doing research into innovation ecosystems for autonomous vehicles, for example, showing the importance and emphasizing the importance of that going forward in terms of both manufacturers and disruptors in reducing carbon emissions through that particular set of developments and innovation. And along with Dr. Marianne Hardy, another colleague, Erin Toll, is contributing to a multi-year project which more locally is supporting County Durham's creative economy, and that's funded by the ERDF and the Arts and Humanities Research Council, and dozens of small businesses across the county in such a way as to focus them on regeneration in the face of some of the challenges to do with sustainability as well. And these and others that I could mention, but I'm keen to get on to Laura and Thomas, are also part of the contribution that we can make and will be making to ESG training as well. So this series of events over May has been highlighting Durham University's thought leadership in the area of climate finance and how we invest in mitigation and adaptation to future climate change. Climate finance is incredibly important to Durham University and has formed a core research theme both within the business school and also the Institute of Hazard, Risk and Resilience. Last week, we started with a discussion on public finance and very long-term investment, of course, crucial. And that entails a detailed discussion of the various impediments to investing in infrastructure and indeed actions that are designed to reduce the degree of global heating and to increase the resilience of communities to the future outcomes. Part of that discussion branched into the role of the private sector. So again, picking up this link of the importance of working in partnership with industry. And this is where we're focusing today, looking at private investment as a driver of investment in mitigation and adaptation to climate change. And in a moment, I'll introduce our speakers on that one. And next week, we'll be focusing on adaptation in low and middle income countries. And that will then be followed by looking at the politics and economics of the next steps in decarbonisation of the UK. So without further ado, I think I've spoken quite long enough, and I'd like to pass over, starting with Laura Marsigliani, Dr. Marsigliani, and also Dr. Renstrom are going to talk to us today on their particular topic. And Laura, I believe you're speaking first in this area of investment and private investment as a driver of those mitigations. So Laura, over to you.
Thank you, Susan. So we are delighted to have been given the opportunity to give a talk at the COP26 Seminar Series at Durham University. My name is Laura Marsigliani. I am an environmental and energy economist at Durham University Business School and also at the Durham Energy Institute. I have been working extensively for more than 20 years on issues related to environmental policies, especially for a public finance point of view. And more recently, together with Thomas and also co-authors outside Durham, we have been interested in the issue of socially responsible investor, environmentally responsible investor in particular. And this is a very fast growing stream of the literature. And however, today we are not going to talk in details about our research. We are going to present some insight from the overall literature in these fields, and in particular, we want want to look at new themes for further research in terms of the role of individual investors and also corporations in providing environmental protection. And finally, we would like to conclude with some food for thoughts and opening up the debate on whether markets alone can provide adequate environmental protection or we still need government intervention. So we start sharing my slides. So in the spirit of what I just mentioned, the outline for this presentation will be as follows. So we will give two separate presentations. One looking at the individual incentive for green investment from the individual perspective. And we will also look at the role of the green financial market. And then we will cover aspects in relation to the role of corporate social or environmental responsibility, CSR, and whether it's correlated with financial performance and, of course, with a positive environmental impact. Therefore, we will look through the lenses of firms, corporations, towards green investments. And finally, we're going to answer the crucial question for this seminar on whether markets alone can provide environmental protection or we do still need a government intervention. So I'll pass the floor to Thomas now.
Okay, thank you very much for this introduction. So I will talk about the finance perspective. And let's see if I can switch the, maybe I have to click like that. For some reason I cannot move the slide. Okay, now I can do it. So I will talk about the socially responsible investment, and what I mean by that is either environmental concerns or social concerns or ethical concerns in investments. I will use this terminology or switching between the terminology. Now, when it comes to firm activity and the way which I would be thinking about it during this presentation is that I think the screen jumped. I need to get back. Okay, Laura, if you go back to the previous, because I think I cannot control it. There we go. So a firm will potentially cause environmental damage, whether that is CO2 emissions or a more local pollution. There may be other ethical concerns in firms' activities. And the idea here is to classify the firms. There are rating agencies doing so and giving firms a score depending on how well they perform in these certain aspects. And that gives information to investors. Some of the investors then will try to shy away from, say, firms that are polluting more, or shy away from, say, oil companies or tobacco companies. And that will inform their portfolio formation or the portfolios they will hold. Now, looking historically on these funds that are specializing in environmental or taking into account environmental factors or social factors, we can see that the funds have grown over time since mid-90s and until today, just in value from 12 billion to 3 trillion. And the number of funds also steadily increasing over time. So we've seen that is something that has become very important in the sense that this market has grown. So if we can have next slide. Now the question here, as an economist always would ask, would this actually matter? Does it change anything? And I should say the theory around this is a little bit underdeveloped. As an economist would always argue, well, each individual does not have enough market power to change things. So if we have one investor investing in green assets defined in this way, they may not actually alter the overall equilibrium or overall outcome. And these kind of channels are not well explored in the literature. So let's see here. There are two ways in which a consumer, investor, or individual potentially can affect the actions of a firm. And one obvious side is through the demand side. So if consumers feel that they want to shy away from goods which are more polluting or have been more polluting in the production process, if many individuals think the same way, they may actually alter the demand, and thereby the firms will change their actions, produce the goods more cleanly, or produce more environmental friendly goods. So I think the demand side is perhaps better understood. The finance side is not well understood. Consumers, if they shy away from investing in firms which say pollute more or produce goods which pollute more, will they actually alter the firm's action? And this is what I'm going to explore here. So when it comes to the finance side, there are two ways of thinking of this. We can think of passive shareholders. So individuals, if they feel responsible for the actions of the firm which they own a fraction of. So if we have a firm, an oil company producing environmental damage, and individuals holding shares in that oil company, they may feel a disutility of holding because they feel indirectly responsible to what the firm is doing. And that concern is actually proportional to what they actually own. So that's one way of thinking of it. So if individuals really feel responsible, they will shy away from those assets. Then of course there will be, I will see that in a while, a pollution premium on those firms who damage the environment. And the firm will realize that they can lower their cost of capital by producing in a more friendly way. So this is something that has been explored, and me, Laura, and Lucas Pataro have explored it. I will talk more about that in a while. There's also an alternative way of thinking of active shareholders. So if we don't like oil companies to do certain things, we could actually start purchasing shares in the oil company and alter the decision of the company through shareholder voting. So that's an alternative channel. And I will come back to this idea in the conclusion. That's something that we have done work on as well. So now, what is the role of government in all of this? Well, of course, the government could, from the outset, regulate or tax those so-called negative externalities, and that's typically how we think about the government doing things. I will come back to government intervention later on in this presentation. But if we are in a case that the government, for some reason, cannot do so, what can it do then? Well, it could try to nudge these private solutions. So governments could start looking to a socially responsible investment index for classifying the firms according to their pollution or their negative effect on the environment or in any other dimension. That could provide one mechanism. And I know that in European right now there are in European Commission, they're trying to do these things, try to harmonize the way in which we classify the firms. We could also encourage, or governments could encourage, shareholder activism. So whether that is through mutual funds taking an active role in the firms they hold shares in, or just foster individuals to become active shareholders. And another option is to try to foster it through education, precisely what Susan Hart was mentioning at the beginning here. So through the way in which we educate our students in universities, and what do we put on the curriculum, and how do we do that? So that is another way in which governments can do that, and actually what universities can do. Now, looking into this finance channel, as I mentioned, if individuals now are going to shy away from polluting firms or socially responsible firms, what are the consequences? And the first thing that we have been asking ourselves is, what are the consequences for the pricing of those assets? Or alternatively, what are the consequences for the expected returns on those assets? And people have tried to look at this empirically. They have tried to see, is it the case that green funds or green investment actually gives higher return or lower return? Now, of course, that will depend on also the risk contents or the covariation with the market of those particular assets. So one has to adjust for the risk. So some of you will have seen before the standard capital asset pricing model, which tells us that the risk premium, or the difference between the expected return on the asset in question in excess of the risk-free rate, is proportional to the market risk premium. And the proportionality factor is just the covariation between the assets return and the market return, the correct measure of risk in this context. And the question is then, this residual, which I have written as alpha on the slide here, and that would be the risk compensated excess return on these particular assets. And people have to try to estimate that alpha and see if there's a difference between green funds and ordinary funds. Usually it's called Jensen's alpha. And it's a very inconclusive literature. We can, some studies get a positive alpha, some studies get a negative alpha. Some studies get an insignificant alpha. And I think there is as many studies on each side of this. And as an illustration, we can see that here. So let me see which one is which here. The red one here is the green index, and the blue is the overall index. Of course, this ought to be risk adjusted, but just looking at this picture, we can see it's whether it's the green portfolio or the ordinary portfolio giving excess returns. It's all over the place. And there is a reason for that, which I will come to when I go through my presentation. So I will move to the next slide. So on theory, there is very little done when it comes to asset pricing and concerns for the environment. So I've been working with Lara Marsiliani and Svetlana Alikova on a project on, it's called a green or ethical capital asset pricing model. I'm just putting up this equation because there's only one point I will make here. But the idea here is that individuals, if they feel responsible for the damage caused by the firm they hold shares in, they will get a disutility from holding those shares. It's not that they feel the damage themselves, it's just the social responsibility or the warm glow that they get from doing something which they think is morally better. It's also referred to as warm glow. Andreoni was the first person to start off this literature. So we have borrowed a warm glow and used that for solving for equilibrium asset prices in this world. And there are several versions of this ethical cap, and we have several different versions depending on what you want to do with it. So the version I put up here is particularly interesting because what we can see here is the usual capital asset pricing model plus the additional term. And this in principle would be the alpha we saw before. And that can take on any sign. So the higher pollution content we have, well, the higher the excess return will be on this particular asset. So that's what we will think of as the pollution premium. But there is also a risk adjustment of that particular asset. So if that has a higher beta, that's a more risky asset, well, then the pollution premium can be lower. So that has to be taken into account when we actually look at the data. And we did some preliminary empirical investigation into this. We can look at that here. So if we have a low polluting firm and a low beta firm, we end up with a medium alpha. But the medium alpha can also be in a case with a high polluting firm and a highly risky firm. So clearly that has to be taken into account when we actually investigate the performance of green funds versus ordinary green funds. And we can clearly we can see why the alpha in the previous literature has been all over the place. So now I will move on to the next part here. Since the individual's preferences when they form their portfolio actually can induce what's called a pollution premium, so that when a firm is polluting more, investors will require a higher expected return on their investment. So it's going to alter the cost of capital in that sense. Now the firm can take that into account. So firms would have an incentive to abate more or aim for cleaner production, even though it may be more costly, just in order to lower the cost of capital. And that mechanism is something that we have looked into. And we see that this particular mechanism can actually incentivize firms to do better on the margin. However, it will not solve the entire pollution problem. So we have shown in the range of papers that we still need government intervention. So still the pollution taxes are needed. The private sector cannot do all by itself, even when investors are socially responsible. And I'm moving on to the conclusions here from this has been a very short overview of what's been done, in particular what we have done in this field. We need, particularly when it comes to green investment, to have the theory informing our empirical investigation. And we've seen that when we looked at our ethical capital asset pricing model. We have seen that social responsible investment, they can marginally mitigate pollution problem, but still government intervention is needed. And I'm going to end with a few, say, problematic philosophical thoughts in this. So if we have different individuals, some individuals are more socially responsible than others. Can the non-responsible investors neutralize the responsible investors in equilibrium? That we do not know. And the other is a contradiction here. So when we have looked at our social responsible investment, we have looked at individuals who want to shy away from polluting shares. These are the passive ethical shareholders. Actually, it can go even further. Ideally, they would like to hold 0 in polluting firms. But why not then going and having a negative holding, short selling polluting firms? What would that mean in this context? That is something that hasn't been straightened out. I think a natural point is to stop at 0. It's hard to see what it means when it comes to negative holdings. We have looked at passive shareholders here in this presentation. But when it comes to active shareholders, wishing to influence the decision of the firm, well, they should actually do the opposite. So ethical active shareholders should actually hold larger shares in unethical firms in order to influence the decision. So these are my final, more philosophical thoughts on this topic. So I'll hand over to Lara.
Thank you very much, Thomas. So in the first part of this presentation, we looked at green investment from the lenses of individuals investors, and we talked about risk premium and the consequences for environmental protection if that decision is left to the financial market, right? So in this part, I'm going through the incentives for the firms for providing green investments. And I will talk in particular about corporate social responsibility or environmental responsibility for this context, and whether that is associated to higher financial performance from the corporation side, and also if it translates in a positive impact for the environment. So nowadays, corporations are under increasing pressure from the government and also from independent rankings to provide some sort of sustainability performance. And here you can see one of the many rankings of sustainable corporation, the one provided by the consultant Corporate Knights for the year 2019, where you can see that the corporations are ranked according to an overall score of sustainability that includes, of course, action to protect the environment, but also issue of gender diversity and pay and condition at work and so on and so forth. So this is more what we can think of a sustainable index in terms of SDGs goals. So in fact, here you see that there are all sorts of industries represented from the food and sector, clothing, and also energy sector. So you see the Neste Corporation in Finland, the Ørsted in Denmark, and so on and so forth. So there is a range of corporations represented in these rankings. And at this point, I want to put some definition of what we mean for corporate social or environmental responsibilities. According to the standard definition by McWilliams and Siegel in 2001, CSR incorporate actions that appear to further some social good, in our case, environmental protection, beyond what is required by law. So there is a component of voluntary action within this definition. So another definition by the economist Jeffrey Hill in 2005 is broader. And then according to the definition, CSR incorporate action which reduce the extent of externalities, external cost. So focusing more on the first definition, right, the crucial question here is, since engaging in environmental protection translates in extra cost for the firms that will have to recycle more, provide some sort of environmental credential, and therefore green investment and so on. So why do firms voluntarily engage in pollution abatement activities? There are several theories here advocated by different papers, and here I have mentioned the seminar paper that first came up with those ideas. And you can see by just scrolling through the slide that those papers emerged mostly in the mid-late 1990s. That was a period in which environmental protection, environmental economics in particular, had a prominent role in the policy debate. And fortunately, there's been a revival in the last few years, and that's why we're here talking about sustainability, sustainable development goals, and what we can do for the government, for protecting the environment. So these theories includes the motivation for attracting the green investors, what Thomas has just talked about, and we know that the evidence is not clear-cut. So we're not sure whether corporate social responsibility actually can be translated in having more shareholder interested in green firms. Another reason for firms engaging in environmental protection that has been provided in the literature is to appeal to green consumers. However, here as well, when we look at data from the retailing sector, supermarkets, for example, these are marketing studies mostly, we see that when it comes to choose green or non-green, consumers are mostly influenced by prices rather than eco-labeling or environmental credentials. So there again, there is no clear cut on whether this is a strong motivation or not. A classical reason is the first mover advantage, first advocated by Michael Porter in the 1980s. So here the motivation is that there are missing markets, that therefore engaging in environmental protection can give a sort of advantage also in terms of innovation, in terms of discovering new markets, and therefore increasing the firm's competitiveness. In the economic literature, however, most of the relevance has been given to the theory that advocate that firms engage in environmental protection voluntarily to preempt future more stringent environmental regulation by the government. And in doing so, they will have a better choice of mechanism to abate pollution. So there will be more flexibility given by voluntary action to abate pollution. And therefore, this will translate in lower cost of compliance and abatement cost. Now, another reason that we explored extensively in the literature is that firms wishes to avert litigation with communities and interest groups. And this is particularly true when we look at the cases of big, high polluting corporations such as the chemical industry, the steel industries, and so on and so forth. So there is plenty of evidence there. In fact, in the economics literature, when it comes to explore the reasons for firms voluntarily engaging in environmental protection, also beyond what is prescribed by government regulation, the literatures are looked at identify the characteristics of the firms that mostly provide corporate social responsibility. So it has been seen that big firms provide more environmental protection, so they engage more in corporate social responsibility, and therefore this might somehow support the idea that they want to preempt future government legislation because by being big, they can influence somehow the process of negotiation in terms of environmental protection between the government and the corporation. And this is what is happening nowadays in many countries, especially in Europe, when it comes to environmental protection. Government and corporations sit together at the negotiation table and try to negotiate whether they should do voluntarily, should do through the private mechanism, or whether the government instead should intervene with stringent environmental regulation. So having a big size, of course, will give a more bargaining power at the negotiation table to the firms, which in turn will try to negotiate with for a lower level of environmental protection overall. Another positive correlation in the literature has been identified between the pollution intensity of the industry and engagement in corporate social responsibilities. And again, this goes back to perhaps the motivation for wanting to preempt the future more stringent government regulation that will inevitably interest the firms that are more polluting. So in that way, they will try to implement somehow that it's some regulation that is some level of environmental protection that is lower than the ones that will be imposed by the government. Also, firms with an active R&D department are also the ones that participated the most in corporate social responsibilities. And again, this is perhaps goes back to the issue of trying to get a competitive advantage in terms of innovation with respect to other competitors. And finally, there is evidence that an industry that is producing goods that are more visible to consumers are also the ones who are more ethical. And this goes back to the motivation of perhaps wanting to attract the green consumers. And pressure for community environmental organizations or lobby groups has also been identified as a push for environmental protection by firms. And again, this goes back to one of the motivations that we have underlined before, that is the wish to avert litigation with lobby groups and also communities. And this, as I said, is a strategy undertaken by big polluting corporations such as the chemical industry. The example here is the responsible care. Okay, so at this point, when after we have assessed which firms are more engaged with corporate social responsibility actions and why they do so, the next question is to look at whether corporate responsibility activities is correlated with a better financial performance. And here there are two main channels that have been explored in the theoretical literature. One that concludes that corporate social responsibility is less costly with respect to government mandatory regulation. And the reason is that CRS preempts more stringent regulation litigation, therefore translating lower costs for the firms. And the other channels that instead see corporate social responsibility as adding extra cost to the operation of the firms, and also because it can lead to over compliance with respect to government regulation. There is evidence of over compliance for several sectors, especially the highly polluting sector in relation in particular to energy companies. So now those two channels can go in the same direction, or they can offset each other. So the theory is not concluding whether CSR is correlated with higher financial performance in financial market. And also the empirical evidence is not at all conclusive. Some find positive correlation with the financial performance, others a negative, but in most cases the statistical significance is not robust. Causation is also something that we should look at. So whether CSR is leading to better financial performance, or is financial performance that is actually incentivize the firms to provide more environmental protection. So these are all issues that would need to be explored further in the literature. A more recent stream of literature has actually looked at the effect of public perception of the environment. For example, nowadays from the media and other information channels, there is a lot of attention on climate change, sustainable development goals. So the idea is whether this public attention can result in better financial performance by ethical firms, and whether regulatory pressure is also an important factor, is inducing firms to engage in corporate social responsibility, and therefore whether this action are translated in better financial performance. So there is evidence that advocate that this is indeed the case. So it will be interesting to see, especially given the latest development in connection to the United States. For example, John Biden has joined again the Paris agreements, and I think will be a COP26 in Glasgow, hopefully. So it will be very interesting to see whether this enhanced public perception of climate change and also associated with the enhanced regulatory pressure by politicians is conducive to CSR activities and also better financial performance by firms. But the focus of this talk is about whether environmental protection by firms, so those corporate social responsibility action, are also environmentally effective, so whether they result in a positive environmental impact. And here, I think the debate boils down to the canonical debate in economics, whether it's better to leave all action to the markets alone or whether government needs to intervene. And the economic view is, I think, is very clear. There are market failures here, in particularly pollution, environmental degradation, climate change, and therefore we need government intervention through environmental regulation taxes mostly. The opposite view is that advocated by the anarcho-capitalist movement led by David Friedman, who is the son of Milton Friedman, the economist, and they claim that government intervention is actually not needed. The free markets will provide all solutions. Now, within this debate, there is no clear-cut theoretical empirical evidence in terms of whether corporate social responsibility is conducive to better environmental quality. However, we can speculate from some case studies, and here I mentioned the one from the declaration by German Industry on Global Warming Prevention 1996, which has been a milestone case in terms of corporate social responsibility across an entire sector in Germany. That there are some hopes that corporate social responsibility by firms can indeed provide a positive environmental impact. But still, there is lots of work to do in those terms. Now, very briefly, I'm going to say why theoretically is not clear-cut whether corporate social responsibility by firms are conducive to a better outcome in terms of environmental protection. And here I would like to refer to the seminal model by Segers and Micheli from 1998 that is also known as the threat model. And it's called as such because although the firms in this model can engage voluntarily in protecting the environment in the true spirit of corporate social responsibilities, however, there is a threat of future and perhaps more stringent government regulation. And as I mentioned before, the firms and the government officers get together at the negotiation table and try to negotiate the level of environmental protection that needs to be delivered by the firm voluntarily. Now, government and firms will have different objectives. The government would like to maximize net social benefits, of course, social welfare. In other words, the firms would like to minimize their cost of pollution abatement. So the results, very briefly, without going too much into the details, as I see we don't have time, the main result is that if the firms have high bargaining power, the level of pollution achieved by corporate social responsibility voluntarily might be lower than the level of pollution. The level of pollution aversion might be lower than that achieved by government regulation. So it's not clear-cut whether a corporate social responsibility can reach a better outcome with respect to government regulation. So to conclude, both through Thomas' presentation on the role of individuals, investors, and financial markets, and through my presentation on the roles of corporate social responsibility in providing high environmental qualities, is not clear-cut whether that is better than what can instead be achieved through government regulation. So both the theory and empirical evidence is mixed. And as I said, most of the empirical evidence is based on case study, and there is lots of work still to be undertaken in this respect. And the literature, it's growing very rapidly and is becoming vast, and mainly based on case studies. Nowadays, data availability is improving, especially in developing countries and so on, and also econometric techniques. And therefore, there is some hope that in the near future, we will have a more clear-cut results in terms of the role of financial markets and firms in providing enhanced environmental protection. And I'll stop here with my talk. Thank you for your attention.
So thank you, Laura, for that. We've got a fairly feisty conversation going on in the chat. So I'll get straight to if there's anything else that you wanted to say, or anything specific you wanted to respond to. But I thought I would start with a few of the more provocative questions. So is that going to be all right for you and Thomas?
Thank you.
Yeah. I think sort of a conversation piece that went out to everyone was like, how do you think, what's the trend in this area? We saw that for investment funds, that in the first quarter of this year was the first time that ESG sustained funds were outstripping new investment from conventional funds. And it was going to happen at some point, but do you think that is that going to continue, or are we you said that the interest in the area sort of oscillated over time. What's your from a sort of futurology perspective, where do you think the thing is going in the next few years?
Yeah, that's a good question. I wish I knew what it would look like in the future. It's been so this seems to come from attention from individuals more and more aware, environmentally aware, socially aware, and it looks like that awareness is just keep increasing. So it may increase even further, but at one point it will stop and become a plateau, where that what these percentages are going to be, I do not know. Is it a case that any socially irresponsible production will disappear out of this, that there would be simply no funding left? That's hard to know. I don't think so. I think there will be a natural mix between the two. But where that exact mix is, I do not know. Will it be 50-50 or that's hard to say.
That sort of brings me on. I'm going to paraphrase Tusha Pradhan's question in the chat, which is that there's a sort of chicken and an egg issue here. Are firms engaging in CSR activities because they're being regulated to do that? And I know you explicitly said that it should be over and above the regulations for CSR, whereas ESG is kind of abiding by reporting principles. But the greenwashing problem is it seems to me to be quite acute here, in the sense of often many of the dirtiest firms are the ones providing the most amount of information on their activities. So is there not a concern here that there could be obfuscation to just simply generate extra investment by pretending to be green, and that you're not actually really cleaning up the entire supply chain of what you're delivering?
Absolutely. I think that's why when we have the rating agencies actually looking into these companies, they will play a very important role to see whether it's actually greenwashing or something better is coming out of it. Or also the why the greenwashing is happening. I think I saw another comment in the chat box here that is it because they're actually anticipating future regulation, and therefore they try to pretend to have done something already now to avoid that future regulation, or we usually think of firms being small enough not being able to influence government decisions or future government decisions. But if there are large companies, they may actually be able to influence government decisions. So by showing or pretending to show that they're doing something, they may actually avoid future regulations. But the important thing there is then that the rating agencies actually, if they can do their job, and it's not entirely clear how to measure these things, but if they can do their job in measuring it, then one should on the margin at least be able to prevent this.
So just wanted to pick you back up on one thing that you mentioned before, which was about whether there'll be literally a dry up of capital for firms that are actually not, it's impossible for them to effectively clean up. I guess my concern, and I think the concern of many people from my perspective, is that in many respects, the need for radical decarbonization of the economy often comes from governments reflecting the principles of the public at large, maybe not the investing public, but the population as a whole, actually then imposing a strategy of investment in the area. And that seems to be a bit that's concerning, because here what you're talking about is the balance of capital. And I'd imagine, how big do you think, from your perception of having spent all this time doing this research, that alpha calculation that you've got there, how big do you think those effects are? Is it bigger than the first term, than the beta? So are we going to see a FT alpha column with, these ESG terms in there saying, hey, look, this is the big bit. This is how you rank your firms, and when you're doing your stock picking, or is it more of a marginal effect, a very small marginal effect?
Yeah, that's a good question. So the question is then, what is the alternative to, well, what is the cost of abating? So having to weigh that against lowering on the margin the cost of capital, and quantitatively, what does that balance look like? I say I do not know the number for that, but you can be absolutely right that it can be numerically so small that it's going to have very little effect. And I think that is also interesting to look into, to see what kind of effect is that. A large enough incentive quantitatively for the firms to do more abatement.
Yeah, I think the concern, I mean, the discussion that we had last week, we sort of likened this to a very slow evolution, and that, you know, if it's too slow, we won't get to where we need to be fast enough. And a lot of what we're doing has to be almost like a different scale than simply individual private firms. It needs to be coordinated, and it needs to be fair. I think Susan mentioned at the start. Susan, if you're still, I think you're still there. There was a sort of a point about fairness, and the fairness of impact and the fairness of cost. And I wonder whether you had any thoughts about how fair things are going to be going forward, and whether whether this can be used as a driver for more parity in terms of how we actually go about paying for the mitigation and adaptation to climate change, climate crisis.
Okay, so I can perhaps add to that. From an economic perspective, a social welfare perspective, we would need to model, right, all this inequality, and therefore how people will be differently affected to this. Now, at a larger scale, we can think in terms of developed and developing countries, right? So, and whether there is any evidence from the financial markets figures or corporate social responsibility figures that suggest that the impact of this corporation and the funds are different in different countries, developing again and developed countries, right? I haven't come across this literature. This perhaps is another promising avenue for future work. And I guess that since climate change, for example, will impact developing countries more than developed ones, also because the developed ones will have more resources for adaptation and mitigation than developing ones. So it would be very interesting to look at climate finance from the point of view of developing countries, and whether those funds, those resources are benefiting the developing countries as well. And also some sort of transference between developed and developing countries. There is already, in terms in the Paris Agreement, this provision for transfer, side payment, technological transfer, and so on. We can think at those transfers in terms of financial climate finance and investor actions that benefits particular projects in developing countries, where, as I said, most of the detrimental effect of climate change will be felt. But yeah, I know that the World Bank, the UN, IMF, that are incentivizing this the climate finance that's to be directed for this developing countries project to mitigate climate change and so on. But we need, as I think it was clear from this talk, the effect is not clear cut. So it will be interesting to look at that and see whether those funds, those resources have an effect where it's mostly needed, which is developing country. And you, Julian, you're going to talk next week exactly about those projects, green investments for developing countries as well.
Yeah,
Bangladesh, right?
I think, you know, I mean, Andy Large and myself, we have a project on this, and I think one of the things, I suppose, that's kind of concerning for me, just from a personal perspective, is that the order of magnitudes of investment that we see cross-sectionally within the developing countries, and I shouldn't say that, I should say low and middle income countries, to be more precise, on the DAC list, you know, from the OECD, versus the rearrangement of capital within capital markets in Europe and in North America, and also the big industrial titans of Asia. They're so disconnected in terms of the size of these things that I sort of struggle to understand how we're going to get to a position in 5 to 10 years where we have the adaptation requirements for low-lying areas in Bangladesh or Vietnam versus the change in the production structure of Western economies, particularly United States. I think that was a sort of a key one, and just to sort of to cement that in terms of literature, in the finance literature, we saw there was a recent article in the Review of Financial Studies which showed that actually, sadly, when companies go public, they reduce their climate mitigation. The private companies reflect altruistically more climate mitigation techniques than publicly listed companies, because there's this cost of capital pressure, and the cost of capital pressure is not sufficient to overcome the need for efficiencies and reductions in costs of goods, increase in profit margins, that sorts of things. And I think that's a major concern. I would say that was quite a major concern.
Yeah, and I think there is more role for government bonds when it comes to project for developing countries and so on. So perhaps a less role, less scope for private finance and more instead for public finance through, I think, the mechanism of government bonds.
Or we have to force the private finance to be a bit more.
Yes, indeed. Yes, indeed. Can I say something about greenwashing that has
attracted? Sure, absolutely, yes.
And yet, these issues can be better approached for interdisciplinary perspectives, so accounting, right, and management as well, and so on. So when it comes to the economics approach, I presented the model by Segers and Miselli, and there the way to avoid this attempt at greenwashing was by having the government, the regulator, for perhaps the Environmental Protection Agency, and the firm sitting together. So the government can keep an eye on what the firm is doing and how it's reporting information and so on. And indeed, that is the way that is undertaken in Europe, where there is this tradition of negotiated agreement, also in terms perhaps of worker rights and so on. So as Europe is more unionized, there have this tradition of coming together, government and firms and perhaps workers represented at the negotiation table and going through the negotiation. In this particular case, it was about the level of environmental protection that needs to be provided by the firm voluntarily, right? So perhaps that is the way forward. And the European countries, therefore, are having already in place this negotiation mechanism across relations with the firms, government and firms. Then I think they're in better position to avoid the greenwashing by having this opportunity for government and firms to negotiate together across the level of corporate social responsibility. The United States, on the other hand, hasn't got that kind of framework, because it's more towards a sort of less negotiated approach to all sort of industrial problems, not only environmental protection but other. So in that respect, perhaps from what I can see, they might be more prone to greenwashing and so on. So just something we can see from the real world. Perhaps we need a more negotiating approach within government and firms and corporations to provide a high environmental protection.
Well, thank you very much for that. Is there, I don't know if Susan or anybody else would like to come in and ask a question now in the last couple of minutes as we start to wrap up. I'm super happy for us to
I would like just to sort of ask the question that I had put into the chat. I may have to switch off my microphone. There's drilling going on, but Felix has come in on the back of this as well. My question originally was really about, because I come from a marketing background, a consumer background, rather than an economist or a finance background. I was thinking about whether and it was at the point where you were talking about the types of investment that might precipitate more genuine work in the fields of sustainability. And I'm thinking here about, sort of investment in sustainability, in new products and innovation, that kind of thing, whether the broad levels of investment, so non-specialist, would start to support that, and when that might happen, because they can see growing consumer concerns with these kinds of issues. So as you've highlighted, there are two factors at play. There's kind of, what you've called social environmental pressures, and there's regulatory framework on the other hand. Well, looking at the social or the consumer pressures, as I would put it, the social consumer, are often go hand in hand, not entirely. It's the question of whether there could be the spawning of different kinds of investors that will invest in those different, more sustainable and kinds of products and even processes. And Felix, you've come back to me to ask about, it's lost a little bit up there. What do I mean by specialists? So you're only thinking of investment banks and funds that have special requirements. Yes, indeed. But I was wondering whether there would be a spin-off. Could there be a spin-off market in specialist investors that would invest in this kind of development? That was my question.
Laura, Thomas, do you want to flag that one?
Yes. Yeah, that is a good question. So let me think if we have, so let me go the other way. So think of general investors. Take, say, pension funds or just a general investment fund where individuals themselves want to save. So will they start having a mix of non-responsible and responsible, let's call it like that, or will there be a separation so that we have some general pension funds and we have specialist environmental pension funds? That's difficult to predict. I think in principle we could have the two types of funds coexist. So some individuals will go for the green pension funds and some will not. It's I'm not sure how much what fractions will be when they coexist, but I think they will coexist. And I think the specialist becomes less specialist in that sense. I think more of the general investors are going to hold the what was before specialist.
Yeah, just a very quick addendum to that one. What the evidence from, as I said, from the US is that when you have private investment through angel investors, venture capitalists, that the distribution of effective outcomes by firms in terms of their carbon emissions tends to reflect more closely the US general population as a whole, because it's private investors reflecting private attitudes. So you're still going to get very carbon intensive industries finding support from those investors who are like high net wealth individuals who support that. And you're also going to get, but you're also getting a substantial and strong investment in new venture creation, which is strongly focused on either carbon neutral products or carbon negative. So actually, reducing the issues. The problem comes when a lot of these companies are switching over to publicly listed companies, and that was what the sort of this disappointing result was that a lot of that activity then sort of vanishes. And so it also depends on the type of investor that you've got and where they're going. And sometimes the market noise is drowning out those good intentions, whereas in the private investment area and the direct investment area, we seem to see a more reflective of the of the views of the population in general. And it's a really good paper to look at, and it just doesn't have a huge number of citations either, which I was really surprised about given the profile of the journal and things. But it had such a profound impact on my thinking when I was thinking about this. So I just thought it was worth advertising that out a little bit. So, anybody else would like to come in there? Laura, any sort of final thoughts or things that you'd like to either agree or disagree with?
Just reflecting on what was the purpose of the talk, so whether the government has still a role to play, and I think we have provided enough thoughts from the theory and the video evidence. That's yes. So to avoid greenwashing, yes, we need a negotiated agreement between governments and firms, even if they are ethical. Perhaps, as you said, to avert that behavior of firms becoming, when they become public, not to therefore be interested any longer in at least at the same extent as before in providing environmental protection. Perhaps there as well, government can look at that issue and nudge, as Thomas was suggesting in his presentation, right? Perhaps also the public can play an important role, and there is, as I said, there is evidence that public awareness on environmental issues and climate change indeed induce higher environmental protection by firms, which is translating into higher financial performances, and therefore induces even more firms to take care of the environment. So I would say, yes, those are the main ingredients. Government action in different respects, nudge, starting with a nudge and going towards more threat of future government regulation, and also public opinion. So there is also a role to play for groups, community interest groups, to influence both the action of the firms and even the financial markets. And as we have seen recently from the financial markets experience of GameStop, and that community individuals can indeed make a difference and can indeed have an impact of financial markets, and therefore on the action of the firms that it's interested both in its financial performance and also in protecting the environment. So yeah, that's, I think it's befitting conclusions. So government can do, but also individuals and
all have a responsibility.
communities and interest groups can do a lot to change what we're seeing, yeah, in terms of environmental protection.
I want to thank our Susan, Laura, and Thomas for their discussions today. This has been a really, an interesting, and I thought today was going to be quite a provocative and a lot of discourse on this type of investing. And given the amount of interest that I've seen over the last 2 years from all sorts of levels of investment community, all the way through to student investment clubs, I'm really glad that we're sort of sitting here at the cutting edge of this particular bit of research, and want to really thank Laura and Thomas for providing that great discussion, and to Susan for the introduction as well. So that's really appreciated. So let's I don't know how we do it on Zoom. It's sort of like we do a virtual round of applause with the little clapping sounds there. So thank you for everybody there. Thank you to everybody who's come in to listen. If you've come and you've heard a little bit and you're interested, or you maybe missed last week and you wanted to have a little listen about public finance, All of these videos will be made available on the Durham University YouTube channel. And last week's one is up there now, and this one will be too very, very shortly. We'll try and get them turned around in a few days. And next week we will be having Andy Large with a little bit of introspection from myself on the impact on developing countries, particularly low and middle income countries, of climate change and investments that are needed to actually mitigate and adapt climate change there. So I'm looking forward. I hope people can join us next time. And thank you very much for coming to the Durham University COP26 Finance